Hi, and welcome to Midas Investing. Today we're going to be taking a look at PayPal, ticker PYPL. PayPal is a pretty major player within the online digital payment space with a dominant presence within peer-to-peer payment services as well. They've recently had a very large decline within their equity value due to large uncertainties regarding the growth of their platform in the future, as well as several of their executives retiring and leaving the company. I'm very excited to take a look at the company and see how it's priced relative to these concerns. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. Hopping into their presentation, which they released with their second quarter results, they performed relatively well with their revenue coming in at the high end of their guidance and large acceleration of total EPS growth. And they reached an agreement within the quarter with KKR to fund out some of their receivables for their buy now pay later business, which is pretty good because that means that they can offload a lot of the more credit risk associated with those receivables off to KKR, which of course comes at a cost, but essentially they're offloading the risk for this cost, which is good. And that also is going to open up a lot more cash flow for them in the second half of the year when they get the proceeds of that, which they expect to put towards repurchases for the second half of the year. Now, as I mentioned at the start, there's a lot of concerns with the company, in particular with the slowdown of e-commerce revenue, possibly with a result of being a pull forward from the COVID period. That's one of the arguments about it, but also a potential that it's just going into slowdown, and also the potentiality that PayPal in particular is losing share to other competitors. One thing I want to point out is just the level of trust that the brand has really built, not just with consumers in particular, but also with merchants. So there's this dual-sided networking effect that has really grown within PayPal, which is one of the reasons that I am very interested in it, even though its total transaction volume is relatively small compared to companies like Visa or MasterCard. Their total exposure across the entire internet space is pretty dramatic. I found this chart on Statista.com, which is a little bit outdated. It only goes up to 2020, but we can kind of make some inferences from there, showing the share of e-commerce merchants in the United States offered at least one buy button on their website as of the first quarter. And you can see a pretty huge percentage up in the mid 70s, and it's grown all the way up through 2020. And we can assume that it probably grew a little bit up through that through the following up years as well. But one thing I want to point out is that another chart I found, or well, a table that I found on the same website covering basically the same period of time, relatively the same information, but breaking it down by the specific e-commerce service providers. And then you can see the overall percentages within it. 71% as of 2020 for PayPal, where we were seeing before it was 70%, and 67% in 2017, where it was about 70% there. And so you can see that in general, the total amount of exposure that on the total amount of websites is relatively small on many of the other purchasers. Now, they may be focusing their efforts on like higher payment volume websites, and that might be part of the strategy. Obviously, but companies like Visa and MasterCard, like I said, in general have very high volumes relative to PayPal, but PayPal has just a mass exposure, so it's become a preferred partner for the merchants, which makes it an even more attractive option for consumers. Hey, now editing Midas coming in here. Days after I made the video recording, they made the announcement finally that an Alex Chris, executive vice president from Intuit, who also is general manager of small business and self-employed group there, is going to be the new CEO at PayPal. So I figured I should probably include a little bit, and I figured this spot would be as good of a spot as any to include that. It seems I would say that given the particular area that he's coming from, the small business self-employed group, and coming from a finance software kind of focused company in general, I think it's a pretty good fit for PayPal. He is relatively untested as a CEO, obviously, so we'll see how he performs in that sense. But I think it's a pretty good choice in terms of his credentials and like his upward trajectory. So we'll see how he goes in the future. And focusing in on the payment services segment, there's other data that I found in particular. This source coming from DataNice. You can see within that segment itself, PayPal in the United States has approximately 60% market share. Braintree, which is a PayPal subsidiary, also having about 2% market share. Stripe being one of the other major competitors up at 15%, and then likewise down the line you can see. And then here's the same information stripped out globally, which drops PayPal down to 40%. You might be like, oh, wow, that's a huge drop all the way down to 40%. But again, globally, there's a pretty large amount of markets that PayPal has not managed to penetrate at all. And a lot of those markets have their own like individual players that are dominant. So there's still lots of places for PayPal to expand. Whether or not they can expand to those areas is another argument entirely. But focusing in on this international part of their business, because that actually makes a pretty big effect on things. You can see the revenue breakdown by region. We have the United States revenue up at about 16 billion, with the next largest being kind of general other, less of the UK, being almost 10 billion, and then we have the UK revenues at 12 billion. So combined together, we have almost 12 billion in international revenues versus 16 billion United States, which is a lot of international revenue. And some investors, particularly United States investors, are maybe a little bit less interested in international revenues depending on things. But I would in particular drive at how much of a strength this is for PayPal. As we were kind of talking before, a lot of individual countries tend to have kind of their favorite payment processor relative to others. It can be very difficult to build a presence for one major one on a global scale. And then if we focus in on some other data that PayPal provides, which is the cross-border share of total payment volume, which we have here, you can see yes, it's declining pretty significantly. You can see it actually being cut in half over this 10-year period from around 24% down to 12%, but nonetheless, or 13%, but nonetheless, in 2022, we still had 13% of the total payment volume being cross-border volume. And so understand this, that's not international, cross-border, meaning going back and forth. So it's about people sending money back and forth between international borders, immigrants, migrants, workers, a lot of remittances and things like that. So this also allows for conversions. PayPal offers currency conversions as part of their services. So the higher this percentage is, it effectively gives them a higher profitability chance for each of these payments. And then even as this percentage declines, because that's the thing I kind of want to point out here, that doesn't mean that the people in those countries stop using it. It just means that they are probably using a higher amount of volume within their own country themselves, which is partially what we were seeing before about the larger overall expansion of the international revenues for PayPal. And then focusing in on a little bit on that even more specifically, a lot of their presence internationally is in Europe in particular. So I did find this other chart as well, giving us some select information on the European countries, comparing about the three most preferred online payment services within each country. And you can see here it's a pretty dominant choice across a lot of the major European economies, especially some of the richer ones. I would point out, not to be biased about that in particular, but then we do see Visa and MasterCard becoming pretty dominant in a few of the countries as well. Denmark in particular, pretty interesting. Finland, Russia as well, I suppose. And then you can see the other category. There's a few of these individual other ones that, like I was saying before, there are some other ones that are just less dominant. But in general, the point is I would show here is that even though, like I said, the cross-border volumes have come down in total percentage terms, that doesn't mean that PayPal stopped being a preferred partner for those merchants and those consumers. And then I decided to do a little bit of my own kind of like ground level research. I'm part of a poll group on Facebook and decided to do a little poll on the subject. POV, you have to buy something from a website. Which of these methods would you prefer to use? I included typing card info directly into the website, and then Apple, PayPal, Google, Amazon, Stripe, as well as other were the choices that I included. And 36% of the people that voted, and there was 160 votes, chose PayPal, including myself. So, a little bit of a bias within there. But then 23%, the next largest of the choices individually that I put there was Apple Pay that was selected, which I would point out because obviously Apple Pay is only in particular for people who have Apple. So there's going to be a little bit of a kind of bifurcation between this, where we could almost have like two polls of people who have Apple versus people who don't have Apple. If we saw the percentages for the poll of people who don't have Apple, this percentage for PayPal would probably be larger than 36%. It might be closer to 50% or something like that. But then 23% of people still wanting to directly type their card info into the site, which is pretty interesting. I would look at this as almost like the opportunity for any of these categories to try to collect on some further market share. All right, so now let's hop into my spreadsheets and we'll take a look at some of the data that makes up PayPal's business before we take a look at my model. So here on this graph in the bars, we have the active users that PayPal reports by year for the last decade or so. Pretty significant growth, as you can see, of their overall user base, up over 400, close to 435 as of the end of 2022. Now on the red line, I have the total user accounts as a percentage of the total global population, just to kind of scale it against something. So you can see as it's gone from less than 2% back in 2013 up to about 5.5% or so as of the end of 2022. But you can see that obviously the growth of that has severely tapered off, and I think that's definitely one thing you can point to show why there would be such a dramatic drop off in the equity value, especially considering against the growth it was having over here before. The question is it stopping there, or is it going to just taper? Is it going to go down from there, or is it going to maybe taper upward a little bit further? Also against this chart in the other bars, I have the merchant accounts, so you can get an idea of just how many merchant accounts have grown over time, which obviously it's a much smaller in nominal terms, but the growth itself is also pretty spectacular, going from about 13 million merchant accounts in 2015 to 35 million merchant accounts in 2022. So that's like a tripling over a 7 to 8 year period. So that's pretty impressive as well. Maybe not quite as fast as this, but still pretty large in a sort of general sense. Now, narrowing in specifically on that, with the two bars from the merchant accounts being before, it's still the merchant accounts. The colors will be consistent between the charts here. So you can see the merchant accounts as we were just pointing out. Then also I included against this, we have the purple line we'll talk about first is the users per merchant account. So previously on the last chart, we were showing the users and the merchant accounts, and now I have zoomed in on the merchant accounts themselves. And here we have the ratio between the two of them, with users being the denominator. So the point of this is that users growing faster than merchant growth in a general sense would have this line move upward. And in general, it's pretty flat. You can see it's actually not really moved too much in general, but it has moved downward a little bit in a general sense. It's moved a little bit downward over the 10-year period or the 8-year period. So in general, what that would show us is that merchants have actually been growing faster than users. And what that means is that it's providing more total buy points for each of the users. You would think that there would be a total amount of websites that are using the base, and then users would spike up and grow. But then eventually there would just stop being enough merchants that are being willing to add PayPal to their services. And then that would make it less attractive for each new user to come online. But instead we have merchants growing faster than users, which means that for each new user to think about whether or not to add themselves to the PayPal network, they think about it and it's like, well, there's actually more merchants available relative to the total amount of users than there was yesterday. So each day it becomes more and more attractive for a user to join. And then with the red line, I included a little bit of different information to kind of show what results from that is that we have transactions per year per user account. So you can see that has grown pretty consistently over time on a pretty linear basis, actually, with a little bit of a little tapering there between 2019 and 2020, but then moving onward upward. All right, now switching over to take a look at transactions, we have on the orange bars the total transactions per year for PayPal up against this. And one thing I would point out is that while we were seeing the overall accounts moving upward at a pretty rapid rate, you can see that this one actually has almost like an exponential scaling upward up until maybe last year where we were seeing the accounts starting to taper off. So it makes sense that the transactions are starting to taper off. But then in the red line, we have the total transactions per account, which is the same as we have on the previous graph. So you can see it's basically the same thing here. And then the green line, we have the dollars per transaction. So this we can dollars per transaction times transactions per account, and then the total accounts, and then multiply all that together, and that would give us effectively the total transaction volume, right? But one thing I point out about the dollars per transaction is that it has moved up over time, but it hasn't moved up over time much, and it didn't really start to move up until really we got to 2020, and then 2021 it grew up a little bit, and then it came down a little bit in 2022. So yeah, up from where it was in 2013, but it's a little bit of a slow growth. Definitely not a very fast growth of the dollars per transaction. It really comes down to more of getting the users to use PayPal more than it does about growing the overall transaction size, which means I think it does it's still managing to basically be a favorite amongst smaller retailers, smaller merchants, smaller websites in general, and also smaller users, lots of that peer-to-peer payments as well. Now switching over to take a look at the total volume, we have here in the kind of golden brown bars, the total payment volume, which is the multiplication of all those three factors that I was talking about before. Very, very huge scaling up in the total volume, going from less than 200 billion payment volume in 2013 up to about 1.4 trillion in 2022. So huge growth in total transaction volume. And this is e-commerce transaction volume. So it's like, this is the growth of e-commerce as we would expect. This is just a chunk of it that PayPal has managed to take as their market share. And then we have the transaction revenue as a percentage of the volume. So effectively, this is like the cut that they're taking within that transaction volume, which it makes sense to see it scale down over time. We see transaction cuts for payment processors tend to scale down over time. Then generally just comes down to how much they can scale their costs with it and how much they can grow the total volumes commensurate with it. So currently down less than 2%. Interesting to see that when we were seeing also the huge drop off in the growth of the total volumes and the growth of the accounts as we were seeing, we also see the decline in the transaction take rate slow as well. So I mean that would be one way that kind of a benefit to go with those negatives, so to speak. It's interesting how that kind of works with it, that this decline seems to be very, very directly related to the scaling up itself in a certain sense. All right, now coming in to take a look at the model that I put together for the revenues and the operating costs of PayPal. You can see here at the top, I have the world population as I was talking about, as well as the incremental growth of the world population over each individual year. And then I have the projection of where the world population is expected to go due to economic experts over the next 10 years. Now we have the user growth as well over here with the incremental growth that I had here, and then the percentage of the population that I was talking about within the model. One thing I chose to do, which is kind of like a sanity check that I chose for the model assumptions that I'm going to go with, is that I took a look at like what is the incremental growth of my user base against the incremental growth of the population, and then I basically subtracted against the previous amount, arguing that basically there's going to be a certain amount of people that might disconnect their PayPal accounts, deactivate them, and then never reactivate them. I'm saying maybe like 5% per year. So there's 95% retainment of users per year as there's new users being added. And then I was taking a look at this on a kind of like an incremental basis, like as the population grows, how much of the new population, relatively speaking, on a typical basis are they adding on any given period. And now for the 10 years that I was looking at, PayPal, it looks like it's about a 50% ratio. And like this isn't like some actual thing. It's not like new babies are being born and suddenly they have PayPal accounts. But the point is that I'm arguing younger people in general are going to be adding their PayPal accounts. So maybe suddenly there's new 18-year-olds and they're adding PayPal accounts, and that's kind of the logic of it. But the point is I'm comparing this 50% ratio, which I would expect to decline over time. And then for my future assumptions, I'm sort of assuming that across my bear, base, and bull case assumptions, I wanted to get something like a 25% ratio, which is what I ended up getting for these assumptions. But like I said, this is just kind of a sanity check factor that I included within the model. And then below that, we have the actual merchant accounts, the users per merchants, like I was talking about, the transactions per account, and then the payment volume, the dollars per transaction. Coming over to take a look at the assumptions that went into the bear, base, and bull case assumptions for each of these. We have 3.5% as an average of the percentage of population that the active users had over this time frame, with a deviation of 1.3. I'm basically relying on averages and deviations and making adjustments from there for a lot of my assumptions within. Now, as we were talking about, we could possibly assume that the percentage of population that they're going to have over this time frame is likely to grow, potentially because it's grown over a lot of time, but we were seeing a tapering off within that growth of their overall population share. So we're assuming that maybe in 10 years they have the same share at 5.5%. That's possibly a bullish assumption. That's possibly a bearish assumption. I'm not sure, but I'm going to call it my base assumption. One standard deviation less than that is 4.2%, and then 6.8 is a little bit higher than that. And those are kind of going to be my base assumptions for how many users there's going to be for PayPal in 10 years. Which doing the math within that gets me to 361 as a bear assumption, 589 million as a bull assumption, comparing against the 435 million that we have most recently. And like I said, I did kind of a sanity check against that, trying to get a general ratio of relative to the incremental growth of the population. And the ratio I ended up with was about 25 to 30% versus the 50 to 60% as we're seeing. So as far as I'm concerned, this is a commiserate with the declines in growth of population relative to the declines in growth of their user base. Then within that, we also are making projections about how many transactions that each of these users are going to do over each individual period of time. As of 2022, it was about 50 transactions per user, which had grown at about 8.7% compounded on a kind of like a smooth average basis. And I'm going to basically make an assumption around those growth rates. I'm going to assume that in the bull case, maybe that transaction per account still continues to grow at maybe 7% per year, which would take them up to about 100 transactions per year for the bull case assumption. In the bear case, I'm getting 4.5% per year growth, which gets us to about 79 to 80 transactions per account, anywhere in between. So then doing the math between this, that takes us up to a bear case assumption of a little bit less than 29 trillion or 29 billion transactions, and in the bull case assumption about 59 billion transactions in 2032 across my assumptions there. Then we come down to take a look at how many dollars per transaction is going to be. We've now gotten up to the total amount of transactions. We had on average for the 10-year period of $59.18 per transaction over that. And then it ended in 2022 at $60.72. So that should show you what I mean by the growth of it not moving too much. It's like, yes, we've had some growth in total dollars per transaction, but it also tends to come down and move up and down a little bit over time. So the point is, while I do think it's likely to grow the total dollars per transaction, I wanted to be very careful in my assumptions about growth of that. And so I chose not to use a growth rate at all, and instead just choose a certain deviation upward from the average, because then that would make a very moderate percentage growth. And I didn't want to rely on actual percentages because it's very easy to overdo it when it comes to compounded growth rates. So the point is either way, we end up with a bear case assumption of about 61.44 for our dollars per transaction 10 years from now, and a bull case assumption about $66 per transaction. And take into account inflation that would likely occur over the next 10 years. So in inflation adjusted terms, I think it's probably in a similar range, which is kind of what I was trying to do here. And combining those factors together, we end up with a total payment transaction volume in the bear case assumption about 1.7, 1.8 trillion, comparing that against 1.3, 1.4 trillion in 2022. And then the bull case assumption, we end up with 3.9 trillion. So a huge growth in the total transaction volume. But again, this is the e-commerce transaction volume and the share of it that PayPal is going to have their share of, as we're talking about. So it's pretty reasonable to assume pretty large growth, I think, across this particular metric. So then coming down the line from there, we end up saying, okay, what's the take rate going to be? We were talking about the take rate of PayPal ending at about 1.9% most recently in 2022. On average had been about 2.5% over the 10-year period. And likewise, this is another situation of I want to be very careful about making assumptions about where this take rate is going to go. We assume it's going to decline, but we also assume the declining speed of it's probably going to slow down over time because they can only decline so far as these costs start to scale, and eventually it starts to affect other parts of the costing. So the point is we're scaling down from the average and based off of standard deviations because that makes it a little bit more mild. And we're assuming that in the bull case assumption, it'll be about 2%. So basically still actually a little bit higher than most recently is. And then our base case, it's going to be about 1.5%. So coming down about 40 basis points over the decade. And then our bear case, possibly 1.1%, coming down a much more significant amount. And so then multiplying all those factors together against the total payment volume, we end up with transaction revenue of 18.8 billion in our bear case assumption and 78.8 billion in our bull case assumption. Both of those comparing against the 25.2 billion that they had in 2022. So you can see pretty significant growth is on the potential table for them in the bull case assumption versus potential declines in a bear case assumption. Now, obviously, this bear case assumption does assume all of these factors have the bear case happen to them. That's one thing you have to keep in mind. But I don't think any of these assumptions are too wildly off. So you can sort of see why PayPal has a dramatic decline, because honestly, these factors are just so sensitive to minor changes to make such a huge change in the total revenue that they're going to be able to get. But it's worth noting that I honestly don't think a lot of the assumptions in this bear case assumption I do think are too pessimistic. So that's one thing to keep in mind. So moving on beyond the transaction revenue, they also have their value added revenue, the other portion of the revenue, which one thing I had noticed is that the percentage of it relative to the transaction revenue or relative to the payment volumes over time had actually decreased rather significantly. So what I chose to scale it against as an alternative was up against the active users. When I did that, I found that in general, it had actually been relatively consistent over the last decade, averaging about $5.69 with a deviation of about $1. So the value added seems to be almost like a fee per user more than it has to do with relative to the volumes. So I chose to scale it against the users, with in the bear case assumption it being about $4.73 per user, and possibly in the bull case assumption $6.65 per user, which brought us up to 1.7 billion in 2032 in the bear case assumption, or 3.9 billion in the bull case assumption. Adding those together, we end up with total revenue of 20.5, 20.6 billion in our bear case assumption, and possibly 82.7 billion in our bull case assumption. So you can see pretty dramatic growth is on the table, even in the base case assumption. And as I had said before, I honestly think the bull case assumptions are far more likely than the bear case assumptions as I currently have it. That's, I guess, my own bias, but nonetheless, we'll still be picking our valuation based off that, because I like to leave a lot of extra upside within my valuations, as you all know. So coming down, I did also model out the costs that they list, their transaction expense, their credit loss expense, operation and support, sales and marketing in general, and admin, as well as in other. They also include the R&D costs, but I like to capitalize R&D costs, so I didn't include that here in my operating income. Now, taking a look at this, they typically talk about their transaction expenses and their credit loss expenses as a percentage of volumes, which makes sense because they're talking about it in terms of trying to think of what their net take rate is like. So I included these metrics here. But one thing I found was that the statistical effectiveness of trying to model off of it was actually better if I chose different metrics for each of them. So instead, I chose to do transaction expenses as dollars per transaction, or really cents per transaction, because as we look at that over the history, it's actually been remarkably stable, close to 50 cents or about 55 cents per transaction within that time frame. And then credit losses we have as a percentage of transaction revenue, which hasn't been quite as stable. It's been on a little bit of a downward trajectory in general over the 10-year period, but that downward trajectory is a little bit more stable and easier to predict. So the point is I chose to base it off of that. The rest of the metrics I chose to do as a percentage of revenue, which is, more typical kind of approach for it. So nonetheless, we made our assumptions based off of that, about a bear case assumption of about 55 cents per transaction for transaction expense, possibly bring it down to 51 cents per transaction in the bull case assumption. And our base case, we're assuming 53 cents, which is just a tiny bit improvement from the 55. Because like I said, we're seeing very, very little improvement in terms of per transaction expense. So I think this is a more conservative approach to modeling out this expense relative to doing it, like I said, as a percentage of volume. Then for the credit losses, likewise, like I said, we did it for against the transaction revenue, likewise here. And then we did similar scaling against the percentage of revenue as I talked about. And I tried to be, in general, like I said, a bit conservative for these first two against the scaling of the revenues, but for the rest of them, I chose to be actually a little bit more optimistic in terms of what the way I think about this is that each of these have been coming down pretty significantly over time as they've scaled up their total payment volumes, and I expect that effect to continue. But nonetheless, if we add it all together, we actually end up with a pretty wildly volatile set of assumptions across our bear, base, and bull case assumptions for operating margins. I end up with negative 8.7% as an operating margin assumption with all of these bear case assumptions on this model. But again, it's several pieces of assumption, all of them the most bear case assumption being multiplied together. So it's obviously very, very pessimistic. And then likewise with the bulk assumption, it's honestly very, very multiplicative as well. It ends up with 45% as an assumption for an operating margins. The midpoint, the median case, 24%, is much more like what I would actually expect. So one thing I chose to do is I chose to kind of moderate out these assumptions a little bit. I was like, okay, well, actually, we'll maybe take the average between the bear and the base case and the average between the bull and the base case. And that'll actually be my bear and bull case margin assumptions. Because like I said, it's like, it is as a result of like 10 to 12 other assumptions before we ended up at this bottom line here. So we will rely on these revenue assumptions, but I will rely on a little bit more of a smooth set of assumptions for the margins of about closer to 10% for the bear case, closer to 30% for the bull case, and then closer to 25% for the base case. It's coming over to take a look at my valuation template. You can see here in the revenue outcomes, I have the short-term revenues modeled closely to the analysis assumptions, though being a little bit more conservative than the analysis assumptions in the short term. And then I have it moving towards the long-term assumptions that we discussed within the model in a general sense. Here you can see the cumulative growth cases on this chart here, as well as the incremental by year growth of revenues here as well. Coming over to take a look at operating margins, you can see for the first 5 years, on average, I have operating margins, which is net of R&D capital expense, coming in at an average of about 24.8%. And then for the next 5 years after that, it's going to be a little bit closer to the 24% exactly. And then scaling downwards into perpetuity closer to 21, 22%, which makes sense to us as we're talking about. We expect them to have relatively high profitability in the short run in line with our model, but then we do expect expenses to sort of be scaled back as competition comes a bit more online. A lot more of those margins do get squeezed, but this might end up being a very conservative assumption against some of those cost assumptions as we were discussing. Coming down here, you can see the trend line for the operating margins over time here, operating income quartiles over the timeline as well. And then the terminal case operating income distribution, you can see here with the majority of cases coming in between about 5 and 15 billion in the 10-year forward period. And then coming in to take a look at capital expenses and how that turns into free cash flows. With our assumptions, we end up with returns on invested capital over the first 5 years of about 20%, over the total 10-year period, also still about 20%, and then coming in towards the 10-year forward period around 18%, with free cash flows accelerating up to an average for the first 5 years of about 5 to 6 billion per year, and then being possibly close to 7.5 billion for the 5 years after that, and then maybe lower free cash flows into perpetuity thereafter. Likewise, you can see the progression of the returns on invested capital, the capital investments as we see it net of the operating incomes, and then the free cash flow distribution in the terminal year as well. And then here you can see the terminal multiple implied by our discount rate and terminal growth assumptions as it comes in. The majority of our assumptions here, kind of the 15-20 range, but with some upside potential with higher multiple revisions. And then how that plays into the fair value distribution, we end up with our quartiles being between 109 and about $58 per share, meaning that we see about 50% of fair value today outcomes between those prices. With the median being about $90 per share, and then an expected value of all of our downside and upside potentials being closer to $89 per share, with expected returns if you were to buy it today with our very conservative risk adjusted assumptions of about 13.6%. Coming down, you can take a look at the fair value distribution as it is right here. So yeah, a nice bump up in values around where we currently are in share price, but then a larger majority of the share price is well above that, with the expected returns all in positive territory, but pretty significantly weighted towards some of the upper teen territories as well. And then taking a look at a simple summary version of the expected cases across our DCF, you can see that right here with our current fair value at around $89 per share, it's currently trading at around the 33rd percentile of the value distribution, which means that we see about 2 times as many potential outcomes to the upside of our current estimate as there are to the downside. About 45% of upside relative to the fair value and 13.6% expected returns at current purchase price. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's going to do it for our evaluation of PayPal. As I said at the start, there is plenty of concerns relative to PayPal's future, but I would like to think that we've discounted effectively against most of those concerns to make it so that most of the uncertainty is more to the upside. I'll catch you all in the next valuation. Bye.